There's a strange silence in America right now. A silence that doesn't sound like peace, it sounds like pressure building under glass. The headlines say the economy is fine. Markets are up. Jobs look steady. Inflation's down from the chaos of 2022. And yet, people don't believe it. Across the country, stores are quieter, carts are lighter, and conversations sound the same everywhere. We're cutting back. The soft landing that policymakers promised feels less like a landing, and more like a freefall slowed down by denial. This isn't a dramatic crash. This is something worse, a slow bleed happening in full daylight. And while politicians tweet victory laps, the American middle class is quietly collapsing under the weight of normal life. Welcome to Frostline Economics, where we don't chase the news cycle, we strip it to the bone. Today, we're breaking down America's silent crisis, the fear behind the optimism, the cracks under the markets, and the political time bomb ticking inside Washington's shutdown countdown. Part 1. Consumer Fear, the Index of Denial. The University of Michigan's Consumer Sentiment Index just posted its sharpest drop since the pandemic. Not during recession, during recovery. That alone should terrify you. The average American isn't stupid. They might not read CPI charts every morning, but they feel the economy every time they tap their debit card. They don't see 2.9% inflation. They see milk that used to cost $2.49 now priced at $4.19. They see rent rising faster than wages, groceries priced like luxury goods, and credit cards stretched to the limit. Household debt just crossed $1.4 trillion, the highest in U.S. history. Interest payments alone eat up more than housing budgets in low-income families. Americans are paying record amounts just to stand still. But here's the paradox. The data still looks okay. Jobs haven't collapsed. GDP hasn't cratered. So the experts keep repeating, everything's fine. It's not fine. Because numbers without trust mean nothing. Consumer confidence is the heartbeat of capitalism. And that heartbeat is fading. Fear changes spending patterns before any chart catches up. People delay purchases, cancel travel, stop investing, and hoard cash. That's the silent start of a contraction. By the time the Federal Reserve sees it, it's already too late. This is not irrational panic. It's rational fear born from 4 years of policy whiplash, political chaos, and broken promises. Americans have learned that temporary inflation can last forever, that stimulus means higher rent, and that growth can make their lives worse. When a nation stops trusting its own recovery, recovery ends. Part 2. The Market Mirage. Turn on financial TV and you'll see green tickers and smiling anchors. The S&P 500 sits near all-time highs, led by the Magnificent Seven: Apple, Microsoft, Tesla, Nvidia, Amazon, Alphabet, and Meta. Together, they make up almost 35% of the entire market's value. But that's not strength. That's concentration risk. Strip them out, and the rest of the market looks like it's in a coma. Mid-caps and small-caps have flatlined. Retail, housing, energy, all stalling. Earnings guidance is being quietly revised downward for 2026, but you won't hear that on CNBC because flat doesn't sell ads. This is a mirage economy, one that shines bright from a distance but disappears when you reach for it. Investors aren't chasing fundamentals anymore. They're chasing momentum. They're buying stories, not balance sheets. That's why Tesla's valuation still sits at over 300x earnings, a number Benjamin Graham would have laughed out of the room. Speculation is no longer a side effect. It is the market. And the danger is that everyone knows it, but no one wants to blink first. Liquidity's tightening, yet asset prices keep inflating. Corporate borrowing costs are rising, yet companies keep announcing buybacks. It's the financial version of a building on fire with the alarm muted. Everyone pretending the smoke is just fog. And under all of this, the foundation of political trust that anchors Wall Street is cracking. Part 3. Shutdown, the politics of paralysis. Here's where economics meets dysfunction. The federal government is once again days away from running out of money. Agencies are preparing unpaid furloughs. Contractors are halting projects. Airports are cutting back shifts. Every week of a shutdown drains roughly $1.2 billion from GDP. That's not catastrophic yet, but it signals to investors that Washington can't perform its most basic function, paying its bills. The longer it drags on, the higher the invisible cost. Credibility. Foreign bondholders notice. Ratings agencies notice. Ordinary Americans notice when their tax refund or food assistance suddenly freezes. The debate in Congress has devolved into theater. Both sides claim they're protecting taxpayers, but what they're really doing is burning trust for airtime. For millions of families living paycheck to paycheck, this isn't ideology. It's survival. Meanwhile, markets are trying to price in political chaos, something they were never designed to handle. You can model inflation or oil prices. You can't model stupidity. If the shutdown extends past December, the U.S. could face the first quarter of 2026 with consumer sentiment at panic levels and government data delayed. That means traders, CEOs, and policymakers will be flying blind. That's how crashes start. Not with one bad number, but with no reliable numbers at all. Part 4. The Global Echo. While Washington burns its own credibility, the rest of the world is quietly reorganizing. China just signed a 20-year digital infrastructure pact with African and Asian partners, locking in resource routes and data hubs. Europe is deepening its energy independence and scaling AI regulations. And in the Middle East, Gulf nations are trading oil in yuan, euros, and dirhams. Anything but dollars. The US dollar is still king, but for the first time, the empire looks tired. Foreign investment in US treasuries has slowed. Global central banks are trimming dollar reserves. Not dumping, just hedging. But hedging is how collapses begin. One small shift at a time. Confidence, once lost, doesn't return easily. And every shutdown, every trade war, every political circus chips away at the myth that America is the world's safest bet. The global echo of 2025 is not a sudden crash. It's a quiet recalibration, away from a country that can't govern itself. Part 5. Psychology of the slow burn. You can measure economics in numbers, but recessions always start in minds. Before a company fires workers, managers feel uncertainty. Before families default, they stop going out. Before investors sell, they stop believing. Right now, America's belief is broken. 62% of citizens think the country is already in a recession. They're wrong statistically, but right emotionally. When collective confidence drops below survival instinct, spending stops, innovation freezes, and pessimism becomes policy. It's not the crash that kills economies. It's the fatigue. A tired nation stops dreaming. And when a country stops believing in growth, growth stops believing in that country. That's the danger of the slow burn. No explosion, no rescue plan, just a long winter of denial. Part 6. The Frostline Verdict. The real story isn't a headline or a chart. It's a psychological shift, from confidence to caution, from momentum to mistrust. If Washington doesn't end this shutdown soon, the chill will spread, from government paychecks to Wall Street risk appetite, from Main Street budgets to global capital. The next recession won't start with panic. It'll start with silence. That silence is already here. So here's the Frostline verdict. America isn't collapsing. It's cooling, fast. And whoever figures out how to rebuild trust before it freezes solid will own the next era. This is Frostline Economics. If you learned something new tonight, drop a like, subscribe, and share this with someone who still believes the calm means safety. Because on the Frostline, the calm is always just before the storm.